I'm Jim Jessup, income strategist with Virtus ETFs. I'm joined by Dave Albright, president and CIO of Newfleet Asset Management. How are you today, Dave?
Great, Jim, and thanks for having me.
Could we talk a little bit about the short duration high yield space and specifically the Newfleet short duration high yield bond ETF, ticker VSHY?
So our bias there has been to be up in quality. Typically we're buying short bonds, yield to call type paper. So, it performed very, very well as a defensive mechanism in the leveraged finance space. Historically, we had been overweight loans due to the attractiveness and rates higher for longer. They provided a very nice income, and probably the place where we began to rotate was right around the time of the yen carry trade, where high yield widened out about 70 basis points, and it gave us an opportunity to reallocate into the high yield space. Right now, I think that we're getting duration benefits by being in high yield. Granted, most of it's callable in short and high in quality, and our up in quality bias has really helped benefit the portfolio.
Could you talk a little bit about where we are in the market cycle in high yield in general?
The high yield market is the highest credit quality ever. If you look back during the pandemic, we had 284 billion of downgrades. Companies such as Ford, Occidental, Kraft Heinz, Hildebrand, to mention a few. These were atypical type investments for high yield. They had 10 and 30-year bullet paper, which typically structure in high yield is 3 or 5 year paper, sometimes 7-year paper. So we got the bullet structures fall into high yield. Credit quality now up to the highest that we've seen. And even though our bias has been to avoid some of the losers, which are very difficult to make up, like a Michael's Stores, a Carvana, a Triton Water, loss avoidance is one aspect of what we do, but also finding singles and doubles versus home runs is another way we can fill out this portfolio.
And when you think about bank loans, which is an important part of this portfolio, but a number of the portfolios that you run here at Virtus, could you talk a little bit about where we are in the loan space as we enter an environment of a rate cut?
Yeah, if I look at long-term defaults for high yield, we're below average due to the fact that the credit quality has improved. If I look at the long-term defaults for the loan market, we're right at historical averages. That's been buffered a little by $1.8 trillion of private credit, which has allowed some of the mid-tier companies that would have had a lot of difficulty finding capital to actually extend their lives. So, if I'm a treasurer of a corporation, first and foremost, I want to finance in high yield, unsecured, if there was an inverted curve, which there was for the last 18 months. Next would be secured high yield, secured bank loan, and my last area of financing, if I'm a mid-tier company, is I'm going to go to the private credit markets, pay more, probably pay 12 or 13%. The one dynamic that we've seen with better economic outlook and sort of a soft landing scenario is a variety of companies have been able to finance in the private credit markets, get their financial house in order, then refinance in the public markets and cut their debt costs significantly. So something we do is evaluate all the credits on a one-by-one basis. And those are the credits that we've been putting into this portfolio.
So if an investor is thinking about the opportunity set in the Newfleet short duration high yield, ticker VSHY, you're going to get the fundamental credit research and in a below investment grade asset class, the risk management associated with Newfleet management, as well as the efficiency of an ETF wrapper.
Absolutely.
Great. Thanks for your time, Dave.